good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at the banking sector as results continue to come in, and we're looking, of course, at two big boys in the regional financial landscape. And we are talking about the NCB Financial Group, or NCBFG, as well as Republic Financial Holdings Limited, or RFHL, for both of their financial years or fiscal years ended September 2020. So both companies would have, or both groups rather, would have reported a decrease in earnings, much related to the effects of COVID on the wider economic activity of the region, as well as provisioning in anticipation of weaker performance in subsequent periods. Let's take a look firstly at NCBFG, and for the period ended September 2020, for that fiscal year 2020, NCBFG reported earnings per share of just around 37 cents TT equivalent, which was a 35% decrease from the 57 cents recorded in the prior comparable period. Now, the net result from its banking and investment activities segment was fairly flat, just 0.5% down from the equivalent of 3.53 billion to 3.51 billion TT dollars equivalent. However, net operating income did increase 19.4% from 4.2 billion to 5 billion, and that much of that was to do with the consolidation of its Guardian Holdings acquisition. And as investors would recall, NCBFG would have taken its ownership stake in Guardian Holdings Limited over the past year or so, up from just under 30% to around 62% in total. So the accounting impact of that would be an increase in net operating income on account of consolidation of GHL's earnings. Operating expenses also increased around 26% from 2.98 billion to 3.75 billion. Overall profit before taxes, however, fell 26% from 1.7 to 1.27 billion, and net profit attributable to equity shareholders decreased at 36% from 1.3 to 878 million. When we take a look at the operating income by segment, we can see that there was some meaningful growth across most of the segments, and we can see net interest income in that bright green shade increased from the equivalent of TT 2 billion to 2.4 billion year on year. Net fee and commission income would have also increased from 882 to 983 million. Investment activities and trading gains would have been one of the segments that fell from 709 to 404 million, so roughly a 43% decrease. And of course, net results from insurance activities skyrocketed from 664 million to 1.5 billion, and much of that again was attributable to that consolidation effect of GHL. Now, operating profits would have shown a fairly similar trend. We can see that there were pretty broad declines for 2020 versus 2019 when we compare most segments, with the exception of the insurance-related segment. So life, health, and pension, the LHP segment would have increased just around 25% from 862 to 1.09 billion TT equivalent, and the general insurance segment again would have increased around 160% from 107 to 286. Again, much of that related to the consolidation effect, or the positive consolidation effect of GHL on operating profits. Now, at a price of $8, NCB is trading at a price-to-earnings ratio of just around 21.5 times, pretty much in line with the sector average of around 20.2 times when excluding First Caribbean International, which is trading with a negative price-to-earnings ratio right now, and offers investors a dividend yield of 1.1%, which is admittedly well below the sector average of around 3.3%. So on the basis of its eventual positive effects of the GHL consolidation, coupled with some normalization of activities over the coming quarters, but again, within the overall context of fairly significant economic uncertainty and that lower dividend yield, Bourse is going to maintain its neutral rating on NCBFG for the time being. Turning quickly to RFHL, the group reported an earnings per share figure of $5.54, which was a stark 43% decline from the 2019 figure of $9.73, or $4.19 decrease there. Net interest income was actually up 4.7% from 3.8 to 3.95 billion, or 3.99 billion, and that would have been related to some of the acquisitions which would have taken place throughout the course of the year. Republic has, similar to NCBFG, been on an acquisition drive in the past few years, and we have seen that fairly significantly being reflected in expansion of total assets for the group. Other income, however, was down 15.5% from 2 to 1.7 billion. Overall net profit attributable to equity holders down at 42.8% from 1.58 to 904 million. It should be noted that for both NCB and in particular RFHL, there were one-off items that would have occurred in the previous fiscal year, which did not recur in the current fiscal year, and that would have, of course, reduced their income or their total profits attributable to equity holders quite significantly. When we take a look at operating segments, there was just a very marginal decline. Operating income overall declined by just around 2.5%, and as mentioned, net interest income grew, while that other income fell by 15% in that pink shade there. And when we look at profit before tax by geography, we can see that Trinidad is playing or has played a much less significant role in terms of contributions by geography to RFHL's overall profitability, falling from 66% to 41% over the course of 2019 to 2020. Increasing in importance was Guyana from 7 to 12%. And we can see that Suriname would have increased from 2 to 8% as well. And the Cayman Islands would have increased from 7 to 9%. Take this graphic with a pinch of salt, of course, because many changes would have occurred over the past year, which would have led to fairly significant shifts in or fairly significant volatility in earnings across major jurisdictions, including Trinidad and Tobago. So at a price of $153, Republic Financial is trading at a PE ratio of 24 times, which is above the sector average of 20.2 times. But again, put it into context, it has been quite a strange year for most companies in terms of their earnings figures, and a 43% decline in earnings would have led to an inflation of this PE ratio, given the fact that Republic Bank's share price has been fairly consistent over the course of 2020, just advancing just around 1.5% to that $133 price. It offers investors a dividend yield of 2%, which is again below the sector average of 3.3%, a fairly significant dip. Republic would have cut their dividends by a 40% for the year over 2019 in response to the uncertainty, that economic uncertainty arising out of COVID. But we expect eventual growth from the slew of acquisitions over the past couple of years. And again, with the normalization of economic uncertainty, however, given that uncertain time of normalization, Bourse is going to maintain its neutral rating on Republic Financial Holdings. But that's it for this week's edition. For more information, you can give us a call at 226-873-8773 or to Bourse. Email us at invest@boursefinancial.com. Or, of course, check out our website at bourseinvestment.com, where all of our research is absolutely free for investors to access. And, of course, you can catch us in today's business section of the Trinidad and Tobago Guardian. Until next week, have yourself a wonderful investing time, and this has been the Bourse Report.